In this video, we're going to talk about something we're all told not to do, and that is trying to time the market. Now, I don't know how to time the market and I don't try to do it, but let's be very frank. We all kind of try to time the market subconsciously or not subconsciously. We're kind of thinking about it, right? Nobody wants to make the wrong decision. So with that out of the way, I'm going to focus on two variables that I find very important when trying to determine whether or not it's a good time to buy or if it's a time to just sit back and wait. Hi, my name is Vas, and I'm a chartered professional accountant by training. I am a full-time realtor that's built and invested in real estate right here in Toronto, York region, and in secondary markets. All of these discussions about timing the market can get very philosophical and academic. And at this point, they kind of lose me because we don't know. So we can theorize as much as we want. As someone who's built Excel models in the past for corporations that take into account just about every single variable you could possibly account for, you realize the bigger and the more complicated your model is, the more wrong it's going to be. Honestly, if you just kind of focus on the one or two variables that are going to have the biggest impact on whatever it is that you're trying to determine or solve for, that is kind of where your answer is going to be. So when we talk about GTA real estate, I mean, yeah, what's happening in China is important. Mortgage arrears, sure, that's important. Mortgage defaults are important. Global debt, all that stuff. But real estate is very micro-based and it's very localized. And before we get into it, let's take a minute and listen what Uncle Warren has to say about all the experts.
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? You know, I mean, just go down the list. No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple of times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
Now let's get right into it. I cobbled together a bunch of charts and I tried to put them together in a way where you can visually see how the charts relate to each other. So in this case, what we're looking at is average home prices for Toronto versus the variable rate historically from 1980 till 2021. It doesn't take a rocket scientist to see that there's somewhat of an inverse correlation. As you see, interest rates go down and house prices go up. So this is why predominantly for every single video I talk about house prices, I talk about interest rates. The one thing of note here is that in 2008, after the financial crisis, you will see interest rates stayed low right here from 2008 up until now, yet prices just continued ripping up. Now the common argument now is that, hey, wait until interest rates go up into double-digit percent, like 12, 13, maybe 15%, and real estate is going to crash. And yes, if that happened, real estate would crash. But let's back up for a second. Now, I think it's important to put the interest rate argument to bed, especially the one saying that we could see double-digit interest rates. I don't think that's possible, and here's why. By the way, I could be wrong, but there is a really good reason why I don't think that's possible. This is the same chart from up above about the variable rate. So this is when we had almost 20% variable rate. This is back in 1981, 82. And below is the chart for the Canadian government gross debt to GDP. Why is this important? Well, when we had, call it 18% in variable interest rate, our debt to GDP was about 50%. Our debt to GDP right now is over 120 because this is 2021. Right now, I believe it's close to 130 or 140. We simply cannot service our debt if we're in double-digit interest rate territory. So yes, we need to increase interest rates to tame inflation, and the government's doing the right thing, although late. But I think that's going to be short-lived, and we're also capped on how long we can go before we start getting into serious risk of actually defaulting on our debt. So no, as far as I'm concerned, we're not going to see double-digit interest rate anytime soon. I try to keep things simple. So interest rate is the number one thing I consider when trying to determine what's happening in the market and where it's going. And then the second one is unemployment rate. Effectively, what the government is trying to balance right now is they're trying to hike up interest rate to tame inflation. But in the back end of that right now, we're most likely entering a technical recession, potential job losses, and things of that nature that come with a basic recession. And with recessions and job losses, market sentiment on the ground floor changes immediately. People are a lot more conservative. I don't think we're there yet because right now, on the real estate front, you still have all the buyers that were there at the beginning of 2022. They're still here now. It's just that nobody wants to get caught buying real estate on a downtrend. Nobody wants to catch a falling knife. Although that saying doesn't even make much sense for real estate, because real estate is not going to go to zero. There's intrinsic value here. So there's not much in the way of fear. But as you can see here, prices of real estate start going up as unemployment goes down. So it's a very basic trend we can follow between both of these graphs. So again, you have here 2008 where we had a bit of a blip. As you can see, it's a bit of a blip in terms of the impact it had on housing prices. Unemployment went up, there's your blip, prices stayed flat, and then the second unemployment started going right back down, house prices started going right back up. This is not new information, but effectively to me this is one of the most important ways to gauge market sentiment. Your typical post-recession recovery takes about 6 to 12 months or 6 to 18 months before we find a bottom and then prices start going back up. Post-recession recovery from the past, I don't know if it's going to translate into what's going to happen this time around, because the run-up from COVID was like nothing we've ever seen. But I think it's reasonable to assume that if we're to take historical data, so let's say it takes 6 months to 18 months to find the bottom, that means that if we started seeing prices drop beginning of February or March, that puts us in a position where starting September and the following 12 to 18 months is where the bottom is going to come in if history was to repeat itself. The good thing about real estate is that it's very inefficient and there's a lot of variability between deal to deal, experience of agents, motivation of sellers and buyers. We're still not at the point where there's fear in the streets, but we're getting there very slowly. Again, it's going to come down to the next rate hike and the fallout from that, and whether or not we're going to have additional job losses and if we're going to actually enter a recession. On a deal-to-deal basis, I'm already starting to see certain deals pop up in different parts of the GTA. Don't think you're going to walk into a Toronto house detached and you're going to scoop it up for next to nothing. In fact, you probably aren't. Right now, I've seen assignments for condos that are closing this year starting to sell below cost, which is a good indicator of deals coming up. I also picked up a townhouse in Newmarket for a client, which I felt was below market. But then on the flip side, I also bid on a house in Vaughan that had 17 offers. 17 offers in the time where typically listings are sitting for, 30 days, 45 days. This particular house in Vaughan was listed for $1 million. Market value was about 1.2. They got offers at 1.2 and over, and then now they're relisted at 1.5 almost. So it just goes to show the variability is very high. There's not that much inventory to begin with in certain pockets, but deals are out there to be had if you're constantly looking, if you're putting in offers, and if you're staying diligent. The people that are picking up the deals right now are those that are actively looking and kicking tires on different listings, especially the ones that have been sitting for a long time. Otherwise, sitting back and waiting for the market to do what it's going to do, I mean, maybe that will work, maybe it won't. Now, the people that I'm seeing pick up a lot of deals at this point in time are the ones that have cash on hand, that they're putting in good deposits. They're still putting in their conditions, but they're coming in strong, because a lot of offers right now are full of conditions. There's no need to put 3 conditions on an offer. One, a financing condition is sufficient. Come in with a strong deposit, have a strong buyer profile. Sellers are willing to leave money on the table if they know their deal is going to go through and they're not dealing with a seller or a buyer that's going to potentially not be able to close on a listing. The early bird gets the worm. Whoever is ready with some dry powder and some cash on the side, for those of you, deals will be had, especially over the next 6 to 18 months. I hope you enjoyed this video. If you liked it, please subscribe and like this video. And if you have any questions, post in the comments below and I'll answer every single one of them. I'll see you in the next one.